Today we have a presentation by Lilit Popoyan. Lilit is a professor at the University of Naples, Parthenope, and a research fellow at the Institute of Economics, Scuola Superiore, Sant'Anna, Pisa. So just to briefly, the usual administrative reminders. You've probably been used to those with all the Zoom meetings. So we'll have 1 hour for the seminar with time for questions at the end. So please be sure to mute your microphone if you're not speaking. So I'll moderate the Q&A at the end. So please put your question, so you can put them in the chat box. You can also put in a star and I can give you the word, or in Zoom you have the ability to raise your hand virtually. So I know you want to ask a question and I can give you the word. And we'll also kind of record the seminar and put it online after the presentation. So we were almost there. We have the last one recorded, so we'll just need to put it on YouTube. Okay, so then without further ado, thanks a lot, and Lilit, over to you.
Thank you, Mark. Let me just a second to plot my presentation. I hope everybody can see that and everybody can hear me. Okay, good afternoon, everyone. Thank you, Mark, for the presentation. Very much hope you are all safe and sound, and the possible lockdown news in the country you are currently don't qualitatively change much of your life. My today's talk focuses on the issues of financial instability and how it can emerge from the co-evolution of interbank and credit markets and possible policy responses to mitigate its impact on the real economy. This is a co-authored work with two of my very esteemed colleagues, Andrea Roventini and Mauro Napoletano, and this work became a reality with funding efforts of Horizon 2020 Project Dolphins and Easy Growth. We have published this paper this summer in Journal of Economic Dynamics and Control. So the details that I skipped during my presentation due to the lack of the time, you can easily find in the paper, and I will be very happy to answer any of your questions and curiosities. I would start my presentation recalling that one of the heritages of the recent financial crisis and its aftermath has been painful reminder about the polyhedral microfinancial linkages and interactions.
I'm just opening up the GFI forum. I'm trying to think. I think we.
And one of the first common causes emphasized in literature on the recent turmoil is the occurrence of rapid financial expansion, or the credit boom. Indeed, if you look at the figure, you will find that the pre-crisis until the first quarter of 2008 was characterized with rapid credit expansion and real GDP growth. However, during the crisis, both showed a notable drop. Another reason for the 2007 and 9 financial crisis was so severe was massive liquidity in interbank and other markets. This destructive impact of the global financial crisis brought to the debate that the pre-crisis financial market regulations didn't take the big picture of the system as a whole sufficiently into account, and subsequently the financial supervision mainly missed the forest for the trees. As a consequence, the need for macro-prudential aspect of regulation emerged. This has recently become the focal point of many policy debates. This has also brought to an intense discussion about the contours of monetary policy after the post-crisis new normal. Sticking to the consideration I have made, the motivation of this paper is fourfold. First of all, macro-prudential policy is linked to other policies, and above all, to monetary policy. Monetary policy affects asset prices and credit, which in turn are very relevant variables for macroprudential policy. As macroprudential policy also directly or indirectly affects those variables, it is likely to influence the transmission mechanism of monetary policy. So in a way, one policy is shaping the playground field of the other, and just monetary policy alone is too blunt a tool for addressing key systemic risks like interconnectedness and build-up of imbalances in specific segments. Second, it is not very clear the way and the form the monetary and macroprudential policies should interact. Should they be complements or substitutes in a function to reach financial stability? Does the interaction between the monetary and macroprudential policy bring to direct application of the Timbergen's principle? And the third, as we'll see also later, relatively well-defined macroprudential toolkits are not very well explored in terms of their efficiency to contain the financial economic vulnerabilities. In particular, there is a debate about the efficiency of new liquidity requirements and possible conflicts of interest between the latter and also the capital requirements, another pillar of the new financial regulations. And lastly, we go to debate actively circulating in a group of central banks about the potential of corridor window in interbank market to be a next generation macroprudential instrument. So what we do in this paper is to experiment two regulatory frameworks: the pre-crisis regulatory approach of Basel II, we call it Basel II, and the post-crisis bank regulatory setup of Basel III, which in its armory has macroprudential tools. Instead, before the crisis, financial regulations have been pretty microprudential. And we are also looking these in combination with different corridor regimes to see the impact of the both on the mechanism of macro level of the economy. So we want to see how the different Taylor rules representing a monetary policy interact with macroprudential regulations under the liquidity stress and what role they have in generating the market freezes. We want to see how do different monetary policy rules and the corridor regimes interact with macroprudential regulations under the liquidity stress. What are the differences in effects of Basel II versus Basel III framework and their capabilities to achieve the financial stability when money market rates are defined inside the corridor system? What combinations of macroprudential and monetary policy rules under different corridor regimes can be the best in terms of macrodynamics effects? And how do changes in a corridor window, the wide, for example, affects the efficiency of macroprudential tools? So you see we have a plenty of the questions. To give you more of a background, here is a table that provides a selection of recent studies on the impact of Basel III components and monetary macroprudential policy interactions. Pay attention that the small selection that I have done, they take models that have both macroprudential and monetary policy. On a closer examination, there are 4 factors which are particularly interesting to look at. First, the majority of studies are putting an accent on analysis and impact of static prudential tools, and as a consequence, the new macroprudential regulatory setup that came after the 2008, 2009, 2010, which is exactly the milestone of the Basel III Accord, is literally neglected. Second, only very few studies are analyzing the impact and the interaction mechanism of more than one component of the post-crisis prudential regulation. The third, you have very few empirical studies. If they are in place, they are mainly looking at borrower-based instruments, loan-to-value, debt-to-income, because there is more data about that. And due to the lack of data, there are very few of those. Fourth, the few studies which at least partially analyze the impact of Basel III's main prudential overlay mainly make use of general equilibrium and dynamic stochastic general equilibrium frameworks. Although it is crucial, especially for the analysis of macroprudential policy and the interaction and the coordination among the agents, it is very important to have a structure that allows for such an analysis. Moving forward, so our contribution, we try to contribute further to the existing literature on a financial regulation by providing an analysis of the impact of both Basel II, the pre-crisis setup, versus Basel III post-crisis setups, main components, looking at them both jointly and in isolation, and to see how it impacts the financial vulnerability and macrodynamics. Further, we look at the interactions between the monetary policy and prudential regulations and the different interest rate corridor scenarios. We also consider the combined impact of micro and macro-prudential instruments to see the optimal policy mix within the prudential monetary policy under a specific corridor system. And we want to see which of this policy mix is the best in terms of financial stability and economic stability. And lastly, we analyzed the emerging market freeze and the contribution of liquidity requirements on the financial stability and their consequences. Jumping a bit forward, I want to anticipate a bit the results. First, it's worth mentioning that the model is able to endogenously generate market freeze dynamics. Our simulation reveals the following result. Liquidity coverage ratio, that is one of the main pillars of Basel III, is not very efficient to curb with liquidity crisis due to its very strong pro-cyclical nature, and it has implications also for credit availability. The width and the symmetry of interest rate corridor matters for financial stability, and it could be an additional macro-prudential tool. Our results also show that macro-prudential and monetary policies are not perfectly substituted to reach a financial stability, but at the same time, under very certain conditions, our results confirm the expected proposition of the Timberger's principle in the sense that, I'm sorry, it seems there is someone who didn't switch off the microphone. I can hear the background noise. Could I ask to switch off the mic? Thank you. So saying this, the leaning against the wind monetary policy is found to be the best monetary policy in the most of the cases, but not in the situation when you use the static capital adequacy ratio together with counter-cyclical capital buffer. And lastly, we found that Basel III performs better than Basel II, and it has very stabilizing effect on financial side of economy. Let me now go a bit in detail into the model to give you some details, mainly focusing on the design of banking sector and financial regulatory stance. The model is an extension of our paper published in Journal of Economic Behavior and Organization 2017. As you can see, the model is composed of two levels of agents.
Devi mettere qua, se vuoi metterti qua, mettiti qua.
Sorry, Lilit, I'm chasing people up on the chat, but maybe just if your mic is on, could you please turn it off so so Lilit can continue with the presentation? Thank you.
Thank you. So we have two levels of agents. On the left side, you see the micro agents. You have consumers, firms, or we call also them shops and banks. And on macro level, we have the macro policy, so the conduct of fiscal and the monetary policy. What structurally makes the model distinct from our previous model is the interbank trading over here in the center, to which I will come back basically later. Direct ancestor of the model that I'm presenting is the one created in Brown University by Ashraf, Gershman, and Howitt in 2011, later the published version in 2017 with some modifications. Our populated economy consists of fixed number capital N of people, which can be consumers, workers, or shops, a fixed number of N of different durable goods, the same number of different types of shops that are producing this kind of goods, and combine both producing and trading options, and the same number of N of different type of labor that the shops need to hire to make the goods we want to produce. Each agent is characterized by a vector of I, J plus 1, where I describes the goods that an agent can produce, and J and J plus 1 stand for agents' primary and secondary consumption goods, respectively. Each agent is also endowed with unit of labor and cannot consume the good he is able to produce. So obviously, this kind of setup introduces a motivation for trading the model. There is a fixed number M of banks which provide loans to shops and accept deposits. Loans are made with completely full recourse, but are also collateralized by inventories. In our model economy, the government conducts fiscal policy. The central bank is responsible for monetary policy by setting the nominal interest rate according to Taylor rule. We opted for two versions: a classical Taylor rule and alternative Taylor rule. It's also fixing interest rate corridor and conducts macro-prudential policy. To have more or less an idea about how the model is working, I want to show you the structure of a model in terms of a matrix. Here, every agent is endowed in a certain period with a schematic balance sheet structure following the logic of the stock flow consistent models a la Godlin-Levois 2007, which will provide that very coherent work, considering that every stock is in line with every flow and vice versa. The matrix describes the accounting structure of the model. So in a way, all rows related to the financial assets or liabilities sum to zero, as you can notice, except for inventories, which are connected to tangible capital and hence does not sum to zero. With a hope to make already big model a bit clear for you, there is a banking sector's balance sheet and how it is working. Banks gather deposits and provide credit to shop owners to finance their production plans. Banks receive credit line applications from their shops that are attached to the bank, and we either approve or deny the request depending on a creditworthiness, a reserve of exposures, and the size of collateral provided. Commercial loans are measured as a dollar value of principal and interest payable this week. The loans, as I mentioned, are fully collateralized by the fixed capital and inventories. The shop owner can borrow up to his credit limit, that is set equal to haircut value of his eligible collateral, to which the bank applies a haircut price. Besides, they can also lend or borrow from other banks in the interbank market or from the central bank to manage their liquidity. Hence, the asset side of the bank's balance sheet is composed of cash reserves held in the central bank, the loans granted to shops, the government bonds, collateral seized from the default shops, and interbank loans to other banks. Liabilities instead include deposits, loan provided by the central banks in case the bank cannot find a liquidity in the interbank market, and interbank market debt. Naturally, the main balance sheet identity holds in the model, and the value of bank's equity divided to two parts, to Tier 1 and Tier 2 capital, is equal to the value of bank's assets minus liability. The loans are granted by the bank based on a very spread bank practice called 6C, like approach of creditworthiness, and based also on a supply of the supply also is restricted by the budget of reserve of exposures, on the base of which the probability of approving the loan request is constructed. When the credit risk associated to the credit request supersedes the bank's limit, firm reserves receives rejection of that request. Otherwise, he's receiving the confirmation. To measure this creditworthiness of potential borrower by this called 6C approach, we are taking into account three main categories: the capital, capacity, and collateral of the shop who is applying for a loan. This is, as I mentioned, very spread practice, considering that in the real world, banks using both credit and non-credit data, meaning that some of those measures of 6Cs, for example, the character, conditions, and common sense, are pretty subjective and are most often based on a credit grantor's historical experience with the borrowers. We account the risk across the first three Cs, namely the capital, capacity, and collateral, that we are able to measure in our model. So the capacity will be measured in terms of quick ratio and return on assets, the capital by debt to equity ratio, and the third C is the collateral. It becomes a part of creditworthiness analysis to provide this payback of the loans. Going forward, I'm going to enter in details in the Prudential Regulations, considering that it is a central part of the model. So in our model, we are comparing the facts of Basel II, versus Basel III regulatory framework. We first run experiments with Basel II Accord, and we stick it to it as a baseline scenario, and later we go to Basel III. The previous Basel II regulatory framework has proposed the total minimum capital requirement, according to which the total capital ratio must be no lower than 8% of risk-weighted assets. Later next, we are going to Basel III requirements with 4 main tools, using a model both jointly and in isolation. In particular, we are considering global capital framework that is composed of static capital requirement that is very close to Basel II capital requirement, counter-cyclical capital buffer, leverage requirement, and global liquidity standard in terms of liquidity coverage ratio. I'm going to enter a bit in details in Basel III and how it is constructed. We try to stick to vary the way as the regulator thought it should be, so following the recommendations of Basel Committee. So minimum static capital requirement in Basel III by construction is very similar to the one computed in Basel II. However, the new index focuses on a common equity, which is the highest quality component of bank's capital, so constraining it to be no lower than 4.5% of risk-weighted assets. In the model, later we have the counter-cyclical capital buffer, and it is determined as follows. So we follow the 3-step procedure. First, we compute the aggregate private sector, so SHOP's credit to GDP ratio. When we compute the credit to GDP gap as a difference between the credit to GDP ratio and its long-run trend computed on a base of regression. Later, we transform the credit to GDP gap into the buffer add-on. The size of the buffer add-on as a percentage of risk-weighted assets is going to be 0 when the credit to GDP gap, so the GT in a formula, is below the threshold J. It then increases with the gap until the buffer reaches its maximum level H. After that, it is going to stay pretty constant. So you could ask me, what's the intuition, what's the idea? The idea is to accumulate buffer in good times to use for the bad times, so to avoid the credit dry up in times where it is most needed, has not allowing the drop of financial and economic cycle, as you can see in the figures. So it shows the difference between the buffer and non-buffer application, and when it is used in bad times, you see that the dampening part, it's a bit ameliorating. Going to the last pillar, one of the last pillars of Basel regulation, the leverage requirement. It is designed to constrain excess leverage in a banking system, also to provide an extra layer of protection. In that, the non-risk-based leverage requirement serves as a backstop to the risk-based capital measurement. The leverage requirement is designed to constrain the excess leverage in a banking system. And lastly, I'm going to introduce you a very central part of this paper in terms of regulation, going to liquidity coverage ratio. The liquidity coverage ratio requires that banks' stock of unencumbered high quality liquid assets to be larger when the expected net cash outflow over 1 month long stress scenario. The banks is going to demand interbank loans exactly originated from this Prudential regulation. More specifically, if the liquidity coverage ratio falls below the minimum value of L, the bank has liquidity shortage and thus turns to interbank market to solve his liquidity shortage problem with the amount to restore the regulatory minimum. Well, in this situation, who is the supplier of liquidity? Here in the bottom, you see IB supply. It is an excess liquidity that the bank can still provide to banks in the form of interbank loans. Hence, the interbank credit supply by bank in the current period is restricted by this budget. To make a long story short, if the bank has satisfied the minimum liquidity requirement and it has additional high quality liquid assets, it can go to interbank market as a supplier. And the banks that have a shortage of it become automatically a demander of liquidity. So in a way, banks need to satisfy all the above constraints of capital and liquidity requirements, has adjusted the composition of their balance sheet to meet the requirement. If bank is not able to meet the requirement, it is in trouble and cannot supply commercial loans. And if its equity goes below zero, it is going to fail. To give more idea about how this market is working, here is a figure. To organize the interbank trading, there is a so-called central clearing counterpart, we just call it like this way, which gathers the information from the banks with liquidity shortage and match with those who can provide the liquidity using the sequential order. This stage of interbank trading starts with placing an order for an amount of interbank loans by the bank who faces liquidity shortage. Central clearing counterpart matches the bank who needs a liquidity to the first bank, if any, in the queue. If the first bank in the queue cannot fulfill the whole demand, he lends to the bank whatever amount he can up to excess liquidity limit, and turn goes to the next bank, who appeared in a list obviously having excess liquidity, and so on, until either the whole demand for interbank loans is fulfilled or the queue runs out of the banks who can lend. The rest of liquidity demand that is not satisfied in interbank market is supplied by a central bank with higher penalty interest rate. Now I'm switching to how the central bank and monetary policy is designed. The central bank sets the rate of interest according to classical or alternative Taylor rule. In the baseline scenario, the central bank follows the classical Taylor rule, or so-called plain vanilla, that is indexed upon inflation and GDP gap. As an alternative, we consider the free mandate or leaning against the wind Taylor rule with inflation, output gap, and nominal credit growth index. Central bank affects the formation of interbank rate throughout the corridor system. Here, central bank has four options. Baseline corridor, when central bank forms a kind of a bilateral standing facility symmetrically on the policy rate. Later, he can decide for a wide, narrow or corridor with respect to the baseline, or to complete a symmetric corridor. So under the corridor system, central bank maneuvers the market interest rate for the interbank loans by operating on bilateral standing facility. A central bank's lending facility allows banks to borrow against the collateral at a rate higher than the policy rate. This acts as a ceiling on a market rate. At the same time, the central bank deposit facility on the bottom allows to deposit reserves and earn interest rate at a rate lower than the policy rate. This acts as a floor to market rate. Together, the two standing facility rates are said to form this corridor, with the policy rate set at the midpoint when we talk about the symmetric corridor. So this type of system is supposed to force the banks first to search for liquidity in interbank market rather than out of it. Going more in details, how the interbank rate is formed inside this market. So how the interbank rate is formed in the market. The model of interbank rate formation is pretty classical in a way. It is very similar to Paul 1968, Whitesell 2006, or Ennis and Weinberg 2007. The central bank is setting a corridor for the interest rate charged on the lending and deposit facilities. On the bottom in the formula, you can see I plus phi L and I minus phi D. Exactly those are is the corridor that the central bank is defining. Where here I is the policy rate defined according to Taylor rule. And phi L and phi D are exactly the standing and the deposit and the lending facility. Obviously, if phi L and phi D are equal, we are talking about the symmetric corridor. And in the opposite case, if it's you have inequality sign, in this situation, you have asymmetric situation. Note that the framework, it it is also in line with the real practice of European Central Bank. At least it is very close. As you can see from the formula on your screen, the interbank rate paid by the bank or interbank loans includes a common component which depends on excess supply of liquidity in a market, and an idiosyncratic risk premium component that is an epsilon. Excess supply for liquidity in the interbank market is defined as a theta on the top. Accordingly, for the bank that needs reserves, otherwise it wouldn't go to the interbank market, interbank rate paid depends on a policy rate I, coming from a Taylor rule, on the current financial soundness of the bank, the epsilon captured by debt to equity ratio, and current supply of excess reserves. That's assuring that banks take money first in an open interbank market before turning into central bank's standing facility. Okay, with these, probably I closed the model part because I gave the main part how everything is generated, and I would like to talk a bit about the validation. Before claiming in every agent-based model that a model is able to shed light on some facts or address policy questions, we first of all need to study whether the benchmark setup of the model is empirically validated. The model is solved by computer simulation. We are running Monte Carlo exercises composed of 100 independent ones, each of them evolving for 60 years time span. The model is fully calibrated on US data. The time series of output gap, inflation, and the real interest rate generated by the model is presented now. You can see it on your screen. The model is exhibiting endogenous business cycle. For example, see the output time series, as well as the fluctuations in inflation rate that is between 1% and 4%. The real interest rate in our case seems rather stable over time. As you can see later in this table, we are trying to compare the outcome, the average outcome of the series generated by the model and US data. And as you can see, we mostly successfully are mimicking the US real data with our 6 parameters. The model particularly is very close to real data in case of replicating the inflation volatility, unemployment, and GDP gap volatility. Instead, as you can see, it overpredicts the real interest rate and bank failure rate, bringing some parallels to our previous model of 2017, on the top of which we added the interbank market. The latter, so the bank failure rate, in the previous model was very close to the real data, but connected to the fact that the banks that don't find liquidity frequently fail, the quantity of failure in this case is a bit elevated. I'm also going to talk about some strategies, how the validation is done. The simulated data appears also to be able to reproduce the very main stylized facts of macro data in line with empirical evidence of Stockton-Watson of 1999 and Napolitan 2006. You see that inventories are more volatile than GDP, while the fluctuations of consumption are milder. The movements between the output and other macro variables suggest, again, well in tune with empirical works, that the consumption, inventories, inflation, and credit are pro-cyclical, whereas unemployment is counter-cyclical. I won't stop much on the validation, even if there are many exercises we have done. Instead, I want to focus on a mechanism of a model to be able later to interpret the results. That is very important. So what is running the model results? I wanted to show it before, so also you, by your own, could arrive why it is happening. To understand mechanism here, how the model is working, I would like to pay your attention on the following graphs. You see the coupled graph of output, autocorrelation, and cross-correlation with credit, available funds, the bankruptcies in banks and firms. As you can see, the credit and available funds are pro-cyclical. Instead, the bankruptcies of firms and banks are counter-cyclical. To be more clear, the credit expands and leads to increase in economic activity, and increase in economic activity is inversely related with bankruptcies both in banks and firms. The mechanism is identical to the one that usually people call financial accelerator on the supply side of credit. So it makes clear that business cycles in models are driven by expansion or disruptions of trade among agents. In particular, recessions are caused by large disruptions in the trade relationships caused by the exit of firms and bank failures. Credit can dampen the above mechanism if it provides credit to entrants and to incumbents, thus contributing to re-establishing all the trade relationship. In contrast, it can also amplify the above mechanism if the shops stop, if the bank stops giving credit to firms and banks. So macro-prudential regulation and monetary policy can affect the ability of the credit sector to dampen or to amplify the shocks. Considering that I have not much time, I'm going directly to the results. So the model is endogenously generating interbank market freeze dynamics. To convince you, I propose to take a look at a graph on interbank rates throughout 50 years on the left side. As you can see, we have cases that the interest rate is kind of skyrocketing. Since the figure on the left, due to its scale, doesn't give you intuition why it is happening, I propose to see the zoomed in dynamics on the right that shows the dynamics of interbank rate in a 42nd year. The graph shows that the dynamics of interbank rate in the corridor with the dynamics of excess supply of the interbank loans. You can easily note an inverse relationship between the two, meaning that the driver of interest rate getting out of the corridor is a demand that is not satisfied, meaning that the bank enters to interbank market but does not find liquidity, and the market gets frozen until the central bank intervenes with a lender of last resort facility. Now, exactly on the impact of different policy measurements crossed with monetary policy and how it impacts certain macroprudential outcomes. So we conduct an experiment to evaluate the impact of different combinations, both jointly standalone, composed prudential tools, both in Basel II and in Basel III, together with monetary policy and different corridor regimes on a range of targeted variables. So here you have output and unemployment. In a paper you have much more. Now you see that the bar plot is exactly for output and unemployment. When we compare with the benchmark scenario that it is Basel II, you see that Basel II is always equal to 1, so we are able to compare with others. The figure indicates that the Basel III framework improves the macro performance of economy. In particular, it has a significant possible impact on output gap and unemployment. We also notice that the leaning against the wind policy has more stabilizing effect almost in all the combinations of Basel III levels, except for the case when you have on the top of leaning against the wind also the counter-cyclical capital buffer. Why it is so? So it is working as such, considering that both the leaning against the wind and counter-cyclical capital buffer are trying to do essentially the same thing, right? If they are both together, they're kind of all overdoing. We are restricting much more when they are together. Moving forward on intuitions, to have more insight of these, I propose that a rather plot of 6 components underlying the vulnerabilities of financial system a la Aikman. This is a plot that a lot of central bankers know very well. The outer polygon represents the maximum value of each component over sample, representing an extremely vulnerable financial system, and central polygon represents the minimum, in which case the system would appear exceptionally resilient. We have normalized the data via normal cumulative distribution function to place the measure on the 1 and 0 and 1 interval, scaling components relative to just their minimum maximum values, and using ranks to provide an order rather than cardinal representation. Radot plot reveals that the standalone implementation of either static liquidity requirements or capital requirements produce worse performance when a Basel II scenario for all kind of monetary policy considerations. Only the introduction of counter-cyclical capital buffer can compensate for this adverse effect of static capital and liquidity requirements. Indeed, the introduction of dynamic buffer, both in terms of macro performance and financial performance, brings to a better impact of static capital requirement. You can notice that both in bar plot and here in a radar, the liquidity coverage ratio is performing really bad. Please keep it in mind. We are going back to this issue in a minute. There is another very important aspect to consider. The result that is delivering the capital adequacy ratio with the counter-cyclical capital buffer setup, especially in the case when you have dual mandate Taylor rule, are not very far away from the Basel III one. This finding supports the claim of Haldane 2012 of Eggman 2014 that advocate for a simpler regulation instead of putting a lot more and drying up without considering what's going to be the next. Moreover, the results point in general to the high complementarity between the monetary policy and macro-prudential policy in delivering both a more stable macro-prudential and banking system. This indicates that the absence of the potential conflict between the price and financial stability faced by central banks. Moreover, our results also are pretty in line with the Timberger rule, detecting that policymaker requires as many instruments as objectives for effective policy results. Now, let's go to exactly understand why expected regulatory instrument, the liquidity coverage ratio, is not really very efficient. We tried to understand what was driving this change in policy experiments, so with respect to the previous model. So we found that the liquidity coverage ratio is very pro-cyclical across the credit cycle. To demonstrate it, we choose a classical way of cross correlations between the output average liquidity coverage ratio of the system and its components. In particular, in the case of binding liquidity requirement means that liquidity coverage ratio is below 1, banks are constrained to increase the amount of high quality liquid assets, thus reducing the amount of credit supply to the economy, which brings to a fail of GDP. Which brings the GDP to fall down. In the opposite case, when the liquidity coverage ratio is above 1, so excess liquidity, banks are withdrawing a part of high quality liquid assets to increase the supply of loans and hence the GDP. So this pro-cyclicality is a very radical departure from the principle of an effective banking regulation and may even offset the benefits yielding by the regulation as such. Moreover, we find evidence of pro-cyclical risk-taking over the financial cycle. We, in one of our presentations in Bank of England, one of the colleagues, Sujit Kapadia, proposed why in this situation not to attach the counter-cyclical liquidity buffer, as we did for capital case, to see what is happening. So pay attention to the radar map to see what is happening in this situation. The macroeconomic and bank performance delivered by the counter-cyclical liquidity buffer is highlighted by the orange line in the radar map. You can see that when you introduce the counter-cyclical liquidity buffer, it allows to significant improvement in the stability of the banking sector. Indeed, the performance of macro-prudential regulation grounded only in liquidity coverage ratio with counter-cyclical capital buffer is not far from the obtaining combined static and dynamic capital requirements, pretty close. The reason, the reason for such an important improvement is explained by the dynamic cross-correlation plot you see on your screen. The introduction of this counter-cyclical liquidity buffer makes liquidity requirement negatively correlated with GDP at positive logs. This indicates that liquidity requirements now contribute to dampening the economic and credit cycle instead of reinforcing them. Indeed, if you have the situation without imposing a buffer, the pro-cyclical risk-taking over the financial cycle decreases liquidity buffers in good times to the regulatory minimum. However, a binding liquidity coverage ratio forces banks to increase their shares of high-quality liquid assets during the economic downswing, whereby kind of reducing the share of corporate and interbank loans. Such a behavior amplifies credit contractions with the result of increasing firms' bankruptcy rates and the share of non-performing loans. I quickly go to the corridor, and this is the last part that I want to address. Again, back to the bar plot. Here you see the comparison between the standalone and joint implementation of different levels of Basel II and Basel III in the presence of different corridor regimes. So the benchmark set up 0.7 and narrow with respect to the benchmark and a wide, and also the symmetric setup. What we can observe here, except for the confirmation that the Basel III performs better, we find that in case of narrow corridor and asymmetric corridor, the macro performance is better. We started to dig a bit to understand what's the matter, and to understand intuition, I propose the following slide. Here is what we find, basically. It is often argued that the corridor system serves for two functions. So it curbs the volatility of overnight market rates, and it also keeps it close to the policy rate. So the second objective of corridor system seems pretty obvious, but what about the first one? Highly volatile overnight interest rate can jeopardize financial stability as well as the effective implementation of monetary policy. In our framework, that is showing obvious signs of financial accelerator on supply side of the credit, that the volatility, when you look at the credit volatility in interest rate, turns to volatility also to output gap, right? In this table, we compare the volatility of interbank rate, output gap, and inflation under different corridor systems based on wide, narrow, and asymmetric. The result of our simulations shows that volatility of the interbank rate can be reduced by narrowing the width of the corridor, and in the contrary, widening the interest rate corridor increases the interest rate volatility. This confirms the result of the model by Lee, one of the famous ones in Journal of Money, Credit and Banking in 2006, that the narrower is the corridor, less volatile it is. So in a way, it gives us an intuition that the width of the corridor can be a potential macro-prudential tool to dampen the volatility of the market. And in fact, you can find many central banks who are using that. An evident case is Central Bank of Turkey, for example. This is my last slide. I quickly go for our main conclusions. So except the fact that the model is generating the market freeze, we found that liquidity coverage ratio is pro-cyclical and it can have implications on credit availability. The width and the symmetry of interest rate corridor matters a lot for financial stability, and it could be an additional macro-prudential tool. We also found that leaning against the wind monetary policy is the best among all the monetary policies proposed, but not in a situation when you use it together with counter-cyclical capital buffer plus the static capital requirement. And we found across all the possible scenarios that Basel II outperforms Basel III, and it has stabilizing effect on the financial side of economy. This is all from my side. Thank you for attention and patience. I ran a bit out of time, and you're welcome with all the questions and curiosities. Thank you.
Yeah, thanks, Lilit, very much. That was a great presentation and really close to the regulatory debate, of course, with kind of a lot of the policy tools that central banks nowadays have at their disposal. So let's open up for questions. So if you have a question, please either put those in the chat box. You can also raise your hand, though I'm not sure whether I can actually see it. So Lilit, you might be the only one to see raised hands. But we got like a question in the chat from Jacob.
I can see that, yes, exactly. Jacob has a question.
Sorry. So I had two questions. One maybe is probably my fault that I didn't get it. What is exactly the monetary policy mechanism in your model? that's the first question. The second part is about this corridor. I mean, maybe I didn't understand, but this corridor is already in place. For example, in the ECB, you have this standing facilities. So I didn't get what do you mean with this another macro-prudential policy? These are the two questions. Thank you.
Thank you, Jacob. I start from probably from the last one. So basically, the corridor in the previous model you didn't have it, considering that we didn't have an interbank market. So the corridor that the central bank is fixing, except that it's a kind of a guideline for the interbank market, and later inside the interbank market, on a base of demand and supply, later the dynamics of interbank rate is decided. The point is that depending how far you go out of corridor, the central bank is intervening. And its macro-prudential side, how it accentuates that both the literature and also our result is saying that if you keep the corridor narrow or asymmetric towards a lending facility or the borrowing facility or the deposit facility, if you keep it narrow, it's kind of, there is less volatility. That is already a very macro-prudential problem, considering that the interbank intervention is pretty much connected to the credit decisions exactly in a bank. If you take the interbank loan, it is kind of participating also later how you make your credit decisions. Already having a shortage of the funds later to normally operate on commercial loan field or not to be constrained on banking regulation. If you have an interbank market that is less volatile and it allows for an easier search for the credit, and you enter there due to the corridor with you find it easily. If you don't, there is always central bank close to the policy rate that is going to borrow you. It kind of drops the volatility. That is pretty much a question of financial stability. This is the main intuition why it is in place. Instead of monetary policy, how it impacts. So basically, considering that in model, we have a kind of a very learning scheme of how monetary policy decisions are taking. And the monetary policy decisions are fed in on a credit decisions. Obviously, the credit decisions are made also on an interest rate. So interest rate is decided by the central bank. This is how basically the central bank impacts also credit dynamics. For example, if you take a look to credit augmented Taylor rule, let me find it exactly here. The credit augmented Taylor rule, it means that if the central bank sees that there is an overflow of the credit, is automatically going to increase the interest rate in a way to dampen this too much credit in the economy. So it has both macroprudential implications, but on other side, it also makes the credit very expensive for the shops who are going to purchase it. So creating an incentive mechanism to buy or not to buy credit. Yeah, Jacob?
Okay, thank you. So basically you have the demand for investments depends on the interest rate, so kind of
exactly. This is one of the main channels that monetary policy affects the financial market decisions.
Okay,
thank you.
Any other questions? Okay, there's a long one in the chat box.
Mm-hmm.
I don't know whether you want to read it out or the person can unmute themselves and ask them directly, maybe.
Probably I can directly go to answer.
Okay.
Okay. Okay, it's a very good question, considering that now we are working on a model pretty different from in this aspect. Between the banks, except the fact that they are present in a trading and interbank market, there is not a competition in terms of clients, like shops. It means that every shop that is born is attached to a certain bank. Instead, banks are competing in interbank market. Instead, now we are working on the model, trying to imitate the systemically important banks. And here we completely inverted this mechanism. Right? So they are not symmetric across different banks. So to have also a possibility to have a bigger or smaller banks. So in this setup, the clients are, the banks are pretty symmetrical in terms of clients, but not in terms of interbank transactions. Instead, in the model that we are working on, we have a pretty good result. There, the client is choosing the bank he wants. So we have emergence of systemically important banks, smaller banks, and bigger banks. I hope I answered your questions. Thank you. It was a good one.
Okay, Andrea has a question.
Yeah, thank you, Lilit, for your presentation. I have a couple of questions. So the first one is, in the very last point of your presentation, you say Basel II outperforms Basel III. So my question is, the reason is for the pro-cyclical liquidity coverage ratio that is not present in Basel II, or there is another reason? The second question is, how do banks take their loan decisions? So they have this liquidity coverage ratio that is somehow, I guess, based on past lending, or do they account for the liquidity they have when they take a lending decision?
Thank you, Andrea. I start from the first one. Why the Basel II outperforms? Unfortunately, I don't have a graph, but it is in the paper. It appears that the main reason why it is happening is the pro-cyclical nature of the two. So Basel II, how the minimum capital requirement is constructed, is very constrained on the drop of the cycle. It means that when the credit cycle goes down, the bank that needs to make a decision to give out a credit or not it's already binding, and he's not granting any more credit. So in a way, due to this fact, the credit is going further down. The same is doing liquidity coverage ratio, and that's why when you look a standalone liquidity coverage ratio, for example here, you see, and later also here, what is happening. Right, here we go. You can see that if you have the static capital requirement that is very pro-cyclical, and you have the liquidity coverage ratio without anything, it is pro-cyclical. It means that when the cycle turns down, it is drying up every possible way of granting a credit. And it turns to this financial accelerator mechanism. The bank is drying up the credit to the real sector. The real sector is not producing anymore, is going out from the market, so the shops are failing, and the GDP is decreasing. Instead, and also this strategy of adding the counter-cyclical liquidity buffer and counter-cyclical capital buffer that is in Basel III, but liquidity capital buffer it is not. When you add those two, those instruments are becoming counter-cyclical. It means that you accumulate something in a good times, and later when you see that the cycle is turning down, you can use those without drying up the credit. So the main message is that the Basel II outperforms, and also in Basel III, if you take the single instruments, standalone instruments, it outperforms because those instruments are pretty pro-cyclical. And in fact, the macro-prudential policy, when it came to place, his main message was, the main mechanism was to provide this counter-cyclicality and break the pro-cyclicality of financial sector. So this was the main side. And I'm sorry, I forgot the second question.
Yeah, okay, so the second question is about how do banks take their loan decisions? So they account for the liquidity they have, or do they somehow account for the past lending when they compute the liquidity coverage ratio?
Yeah, great. So basically how the shops are operating. They have, in each period, they have a production target. We have a production target, we have the price decision taken, we know how much money we need to hire people and to produce that. Later, we have internal finance if we have accumulated something. So we are comparing the targeted output we want and whatever we have, and on a difference, we try to make a decision to apply for a loan, to care about the expenses to reach the potential, the output target we have. This is the main mechanism how the loan decisions are taken.
Sorry, I meant the banks. How do they decide how much to lend? I mean, they account for the liquidity, or they just lend and they try to
Let me
retrieve the
go
liquidity?
to this slide. Probably I was not very clear. Here we go. So basically the main way, I'm trying to get rid of the participation list to be able to, here we go. So basically how the credit supply decision of the bank is made. The main way the bank is taking the decision is first deciding how reserve of exposures he has. So basically the main guideline is the minimum capital requirement. So he's computing the minimum capital requirement that is required to keep as a capital, and whatever he has left after that, it is reserve of exposures. Based on how far he is from the reserve of exposures, he's assigning a probability. So basically, if there is a lot of reserve of exposures, the probability that he's going to confirm the loan is higher. And if the reserve of exposure is close to zero, he's going to reject it. Another way of deciding, if, for example, he decided that he's granting a loan, later he's going to evaluate the shop with the categories of 60-lakh approach of credit worthiness. It means that the shop who has applied for the loan, he provided his balance sheet that I have, and he is computing the ratios, the quick ratio, return on asset, debt to equity, and also he takes a look if the guy has enough collateral, and he's granting a loan, applying a haircut on the collateral that he has. So not more than that. So it doesn't mean that whatever quantity that the shop wants, the bank being able to grant a loan and having reserve of exposures is able to give. So it's kind, if he's deciding the reserve of exposure, he knows the probability of granting a credit. He's looking at the balance sheet of the shop to understand if this guy is credit worthy. And based on our collateral he can provide, he's deciding the amount of the credit. This is basically the chain of the decisions that is running how the credit supply decisions are taken in a bank. Okay.
Okay, thank you. So they are not accounting for liquidity,
yeah,
for their own liquidity. Okay, thanks.
Okay, so in the interest of time, maybe if there's a really quick last question, we can take that one now. Okay, here. Okay, so I guess, I guess nobody has a question. Last chance. Okay. Okay, that's fine. Okay, then yeah. So then, thanks a lot, Lilit, and thank you all for participating in the seminar. So just like one final announcement, which is just like a quick preview for the next seminar on the 18th of November. So the presenter will be Danilo Spinola from Maastricht University, and the topic will be the macroeconomic impact of public and private R&D networks. So if you're interested, then by all means, please sign in 2 weeks, and we'll send out more information in a week's time. All right, thanks very much, and take care, and yeah, have a good day. Bye.
Thank you a lot. Have a nice day.